The world just crossed a line in the Middle East. Not tension, not sparring, not another headline. A real escalation that forces markets to reprice risk in real time. And the moment that line gets crossed, two assets get dragged onto the front page whether they want to be there or not. Gold and silver. But here's the trap. Most people think war headlines mean a clean, instant rocket. Green candles forever. No pullbacks, no whipsaws, just up. That fantasy is exactly how people get chopped up. Because the market doesn't move like a movie script. It moves like a stampede through a narrow doorway. And if you don't understand the mechanics, you'll buy the top of the spike, watch it snap back, and then swear the whole thesis was fake. So today, we're going to do the uncomfortable thing. We're going to separate the story people want to believe from the structure that actually moves price. And yes, if you want these no-fluff breakdowns as the week gets more chaotic, subscribe. One click, that's it. It keeps you ahead of the next wave instead of reacting to it. Now let's get into what's really happening. Most people keep asking the same question in different ways. Is war bullish for gold? Does silver explode when missiles fly? Should I buy right now? Those are normal questions, but they're framed the wrong way. Because war is not a single lever that you pull. War is a spotlight. It shines on weak points that were already there. Debt, leverage, currency confidence, supply chains, energy vulnerability. The headline doesn't create the weakness, it reveals it. And when weakness gets revealed, people behave differently. They hedge, they hoard, they de-risk, they demand collateral. That behavior is what moves gold. That behavior is what whips silver. And right now, that behavior is waking up again. Here's the first mindset shift that will save you money. Stop trying to predict the spark. Start measuring the pile of dry wood. If the financial system is stacked with dry wood, a spark becomes a wildfire. If the system is damp, sparks fizzle. So what is the dry wood today? It's not one thing. It's three engines bolted together, all revving at different speeds. Engine 1, fear. Engine 2, currency confidence. Engine 3, rates and liquidity. When all three engines pull in the same direction, you get those "what just happened" moves that make people stare at the chart like it's a crime scene. When only one engine turns, you still move, but it's messy, choppy, fake-outs. Headlines that should move price and don't. This is why your brain gets punished if you demand a clean reason for every candle. Because markets are not clean. Markets are conflict between players with different time horizons. Now let's talk about silver, because silver is where the confusion turns into loss. Silver is not gold but cheaper. Silver is gold's high beta cousin with anger issues. Silver is a monetary metal and an industrial metal at the same time. That means silver can be pulled by fear and pulled by growth in opposite directions in the same week. Gold doesn't have that personality problem. Gold is simpler. Gold is trust. Silver is trust plus factories. So when people ask, if gold is at records, why isn't silver ripping even harder? Here's the real answer. Because silver is constantly negotiating between two narratives. Narrative A, the world is unstable. I want hard money. Narrative B, the economy is slowing. I don't want cyclical exposure. That tug of war is why silver looks like it has mood swings, and it's why silver can do something brutal in a risk shock. It can drop first, even if the long-term thesis is bullish. Because in the first wave of a shock, the market doesn't sell what it wants. It sells what it can. It sells what's liquid. It sells what has leverage attached. It sells what triggers margin calls fastest. Silver is guilty on all counts. That's why you can see the paradox. Bad news hits. Everyone expects metals to spike, and silver gets slapped. Not because the thesis died, because the plumbing choked. Then the second wave hits, after the forced liquidation, after the margin calls, after the weak hands are cleaned out. That's when repricing starts. That's when gold acts like collateral. And that's when silver often follows, sometimes late, sometimes violently, sometimes with a grin. So when you hear, gold and silver will skyrocket because of war, you need to translate it correctly. It doesn't mean straight line up tomorrow. It means higher volatility now, higher probability of higher prices later. Those are not the same promise, and confusing them is how people blow accounts. Now let's zoom out because this isn't just about one region. What's happening is part of a larger shift that most people still refuse to admit. The world is moving from efficiency to resilience. Efficiency is just in time. Resilience is just in case. Efficiency is cheap. Resilience is expensive. Resilience means duplication. Resilience means inventory. Resilience means paying more for safety. Resilience means rebuilding supply chains closer to home. And when a system switches from efficiency to resilience, the price of real things tends to rise. Not smoothly, but structurally. This is why gold has been behaving like a reserve asset. It's not because everyone suddenly became a gold bug. It's because in a world where trust gets shaky, collateral becomes king. And gold is collateral that doesn't require permission. That word matters, permission. Because the modern financial system runs on permission. Banks, payment rails, settlement networks, access. When geopolitics gets sharp, access becomes a weapon. And the moment access becomes uncertain, countries, institutions, and big pools of capital start thinking differently about reserves. They don't trade like you and I. They don't care about being early. They care about reducing vulnerability. That's why the official sector bid has been stubborn. Even at high prices, it doesn't behave like a retail trade. It behaves like long-term insurance. Now here's where people get trapped by a clean story again. They hear that and they think, okay, so gold only moves because of war. No, war is not the only driver. It's one of the sparks. But gold is a voting machine with different voters. Some voters are central banks. Some are funds. Some are regular people protecting purchasing power. Some are momentum traders who don't care why it's moving. So yes, conflict can light the match. But the fire is usually built from other materials: deficits, liquidity expectations, and confidence. Sometimes the market even uses the war headline as a convenient narrative to justify a move that was already loaded. That sounds cynical, but it's real. The tape tells stories, and it doesn't always tell the honest story. So the better question is not, did war cause this candle? The better question is, was the market already coiled? Were real rates already softening? Was liquidity already easing? Were buyers already accumulating? Because if the structure was bullish, the headline is just a trigger. If the structure was bearish, the headline can create a spike that fades. And that brings us to the part everyone is ignoring. The Middle East escalation isn't happening in a vacuum. It's landing on top of a global system that already has pressure. Supply chains, energy security, shipping routes, insurance costs, and a growing rivalry between major powers that is not going away. This is why the skyrocket narrative keeps coming back. Not because people are dramatic, because the distribution of outcomes is widening. And when outcomes widen, hedging gets more valuable. That can pull capital into hard assets. Now let's make this practical, because this channel isn't here to entertain you with doom. It's here to help you make decisions without blowing up your life. So here's the usable framework. Think of gold as a staircase. Think of the world as an earthquake. The staircase still goes up over time, but the building is shaking. You will get jolts. You will get dips. You will get fake-outs. You will get days where the news feels terrifying and gold barely moves. And you will get days where the news is quiet and gold decides to sprint. If you can accept that reality, you can hold through volatility without panicking. If you demand clean, you will get punished. Now, silver. Silver is the staircase in the same earthquake, but the steps are narrower and the railings are loose. The upside can be bigger. The path can be nastier. Silver will test your discipline. That is not a moral statement. That is a structural fact. Because silver attracts leverage. Silver attracts speculators. And silver is more sensitive to sell what you can moments. So if you're in silver, position size matters more than your opinion. Now let's talk about the bigger theme behind metals, because here's the cliffhanger most people miss. Gold and silver are not the whole trade. They're the foundation. If the world is reorganizing itself for resilience, there are other pressure points that get funded. Energy, industrial metals, strategic infrastructure, and yes, AI. Because AI is not just software. AI is power plants, transmission lines, copper, cooling systems, and concrete. AI is physical. It is infrastructure. And as data center demand explodes, energy becomes strategic again. Not boring, strategic. And when energy becomes strategic, the entire commodity complex gets dragged back into relevance. That's why you're hearing more talk about copper, nuclear buildout, and shipping bottlenecks. It sounds like a random grab bag until you see the thread. The thread is infrastructure under stress. Copper is the quiet killer in that story. Copper doesn't have the mystique of gold. Copper doesn't have the cult of silver. Copper is just necessary. And when something is necessary, demand doesn't ask your permission. It shows up anyway. But copper supply is slow. Permitting is slow. New mines are slow. You don't turn on copper production like a light switch. So if the world is serious about grids, electrification, reshoring, and defense spending, copper feels it. Not instantly, but relentlessly. Now energy. Energy is the fastest channel through which geopolitics translates into consumer pain. Shipping lanes and choke points are not academic. They're pricing inputs, they're insurance, they're lead times. And when those things get stressed, volatility spikes. Again, volatility is not just emotion. Volatility is positioning. When traders are over-levered, volatility increases because forced selling becomes dominant. When leverage gets flushed, volatility can compress even if the trend stays up. This is why a grind phase does not mean the story died. It often means the market is digesting. And digestion is where the next move is built. That's the part most people can't tolerate. They want fireworks every day. Fireworks are the exception. Trends are the norm. And people who learn to prefer trends over fireworks end up doing better than the crowd. Because the crowd buys fireworks and sells boredom. Now let's bring it back to the main claim of this video. Gold and silver will skyrocket as conflict turns into war. Could we see a spike? Yes. Could we see a repricing? Yes. But let me warn you about the exact trap that headline sets. It makes people expect a straight line. And straight lines invite leverage. Leverage invites liquidation. Liquidation invites regret. So if you want to be smart, you don't trade the word skyrocket. You track the structure. And the structure is this. If conflict intensifies, the probability of higher long-term prices rises. But the path becomes more violent. Meaning the best strategy for most people is not bet bigger. It's size correctly and don't get shaken out. Because most losses happen at the worst possible moment, right after a dip that feels like the story is over, right before the market resumes. So what should you do practically? First, decide which game you are playing. Are you trading headlines or positioning for a regime shift? If you're trading headlines, you need tight risk controls and you must accept you'll be wrong often. If you're positioning for a regime, you need patience and you must accept the path will be annoying. Second, respect the difference between gold and silver. Gold is typically the steadier hedge. Silver is typically the higher volatility expression that can outperform, but can also punish you emotionally. So if you treat silver like gold but cheaper, the market will educate you the hard way. Third, stop confusing contrarian with early. Being contrarian is a philosophy. Being early is a cash flow problem. You can be contrarian and still get wrecked if you don't have a plan. So the rule is simple. When everybody is bragging, get cautious. When everybody is depressed, start hunting. Not because you're special, because crowds overshoot. They always have. They always will. Now, I want to pull you into the next cliffhanger because this is where the next months get spicy. The world is not just dealing with one flashpoint, it's dealing with multiple. Some are loud and immediate, some are slow and structural, and markets don't need certainty. They only need probability to change. When probability shifts, positioning shifts. When positioning shifts, price moves. So the right question is not, when does the next war happen? The right question is, how much pressure is in the system right now? Because when pressure is high, any spark matters more. And when pressure is low, sparks die out. That is how you stay sane. Now here's my question for you, because I want to see how you're thinking. If you could only overweight one category for the next cycle, what would it be? Precious metals? Energy? Industrial metals like copper? Or the picks and shovels infrastructure behind AI? Pick one. Tell me why. One sentence. And second question. Do you think the next major move in silver comes as a clean grind or a violent spike and flush first? Drop it in the comments. I read them, and it tells me where the smartest viewers are leaning. Now let me land the plane. The takeaway is not, A specific war date means buy now. We don't do that. The takeaway is that the market is pricing a world where conflict risk is higher, supply chains are being rebuilt, and capital is being reallocated toward hard assets and strategic infrastructure. In that world, gold can keep behaving like reserve collateral. Silver can keep behaving like high beta chaos with upside, and the commodity complex can become more relevant than most people are ready for. But the path will not be smooth. So be careful with leverage. Be careful with position size. Be careful with the story you tell yourself, because the story you tell yourself determines whether you hold through volatility or panic at the exact bottom. And if you want more breakdowns like this as this situation develops, subscribe. It's the simplest way to stay plugged in without drowning in noise. And the standard reminder, this is education and market commentary, not personal financial advice. Do your own research and talk to a qualified professional who knows your situation. All right, drop your answers below, because the next headlines won't ask you if you're ready. They'll just hit.